Just why is March so high risk for you?
Well, good morning, John. Yeah, I mean, normally March can be both seasonally positive or negative, but what we're seeing is this pattern over the last year where, we're in an earnings downtrend. And there's a presumption now, I think, by the market that because the economic data has been a little bit better than expected, including what we were expecting, that the earnings declines are now over. And that's not what we think. And the way the market's been trading over the last 3 or 4 quarters is, the market figures it out the month before earnings because the word kind of gets out that maybe things aren't so great in that last calendar month. And then, of course, when the companies report and the numbers actually come down, the stocks have kind of relief rally, thinking, okay, the worst is behind us. But it's been kind of this, repetitive pattern. So if that pattern holds, then March should be the month where the first quarter earnings get digested. Even though the revisions aren't coming down yet, the market gets ahead of it by about a month.
Mike, there is a concept that I hear you use and see in your research repeatedly. It's negative operating leverage. Now, Mike, for people who aren't in the equity market like you are, don't follow this stuff like maybe other people do, what does that concept mean and why is it so important right now?
I mean, it's a very simple concept. Anybody who's been doing this, for any period of time understands it, which is that, when you get positive, well, operating leverage is basically the leverage the company's earnings have to revenue growth. And so in the pandemic, of course, we had incredible positive operating leverage because costs were slow to come back as people were stuck at home, but the revenues came roaring back as we digitized the economy and we were able to operate. So we had this windfall profit. And we think that windfall profit was very broad. It wasn't just a few companies benefiting from COVID. It was all over the economy. And as you know, John, we've been talking about this for a while. And now, of course, we have evidence that that operating leverage is going negative, meaning we're seeing a deterioration in revenue growth, but then we're getting a much more severe decline in the earnings. And we just saw a couple of companies you mentioned in the retail space where that is being played out in spades. And that is going to happen across the economy. The evidence is already overwhelming. It's been most apparent in the tech space because that's where the overinvestment was the most egregious. And now we're seeing companies deal with that. But we think they're going to be woefully slow to get those costs down to a level where we think they need to get the margins to stabilize. So that's the thesis. It's playing out. I think some people think the worst is behind us. We think the worst is still probably ahead for most companies.